Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right then, today we're going to be taking a look at the SLV, which is our proxy for the silver market, and we're going to be looking at the CFDs on gold as well. Now, it's been a while since I've done an update on precious metals, especially silver, but I can't put it off any longer. I've got to basically give you an idea of what I think is going on. Nothing's really changed in the long-term count. I've just had to come to terms with certain things I don't like about it. But there are certain things I love about the classical analysis setup that I think are very positive and a very strong sign of having put in a sustainable low. I just can't necessarily express it in the most Elliott, in the most beautiful Elliott wave way. That's all really. So let's not waste any more time chatting about that. Just a quick note, if I'm coughing and spluttering a little bit during this, I'm sorry. My throat is extremely sore and dry after a 5-hour live stream yesterday on top of what was already a bit of a sore throat, so I'm going to muscle through and do the best I can. Now, because it's been a long time, we're going to start here on silver first. Okay, and before I come into the count, because the count really is of secondary concern to what I want to point out today, so we're just going to turn the count off. And we're going to look at a few things first. We're going to look at our classical analysis and the things that I feel are the most significant points I wish to make. So let's just zoom out and get a sense of scale for the moment of this long-term chart on SLV. So we've got the peak here back in April of 2011 and the bottom of March 2020. We've then had a move up and a move back. All my instincts say that this is an impulse and this is a correction. And therefore this is the next thing that's going to happen. It may not be to here, it may be a free wave correction, and it may go lower. I don't know, but I am siding with the idea that it's going to go higher. That's my personal bias, which I will acknowledge, and that's how I view the current price action. Now, let's just bring on our long-term VRPV, and I want to point out, yes, we don't have all of the historical data that we would on the CFD chart going back for the entire silver market, but we go back to 2006 and the run up into the GFC. Now, all of the thickest area of trading and volume is all around here, and that's right where we bottomed, right on this point of control. This point of control coincides with a long-term support and resistance level where we've got series of highs, 4 or 5 here, couple here, 3 or so here, support levels here, resistance levels here, operating as support now, which goes back for as long as the chart goes back. So we've come through that level, which has been a basing level before. We've come through that level violently, and we've taken a fair old time to work, more than 2 years, to work our way back down to this point, and we've bounced like buggery. That's reassuring in itself. From a bullish perspective, we've broken a major resistance level, we've come back to our point of control in the volume, and we've bounced from that level. So that's a very long-term look. Let's now come in and have a look at everything from the COVID low. What I want to point out here then, there's more than just that long-term point of control that we've come back to. It happens to coincide with a shorter range point of control as well, which is this impulse. Now, people who watch my channel frequently or members of the Patreon will know that I often use fixed range volume profiles to look for the most likely areas of demand via a correction back in to that prior impulse. So we have that impulse, and then we look through a correction on whatever scale it is, small time frame, larger time frame, and we're looking for the areas of interest where there might be support. Now, we've got horizontal support we've already discussed. We've got a little buy zone here around our point of control. If we project that forward, it happens to overlap very nicely with the long-term look we had on the weekly chart. Right, so let's put that over here. We can see that's our low. That's operating as support along with our long-term horizontal support line, right, which is right on it, which we looked at on the long-term time frame as well. We've come straight back to that support. So that's a little demand zone, as I like to call it. we've got our little supply and demand zone areas here. Basically, all we're looking for when we're talking about demand is we're looking for coming up to resistance. In this case, these prior lows becoming resistance. We're looking for a move up to resistance, a move back, okay, a counter trend move which finds buyers. Okay, we've got the volume profile in here to support, we've got this increasing volume here, okay, we find buyers and then we erupt higher. Right. So this is a previous little demand zone. It's only tiny, but it is nestled in amongst all of this horizontal support, long-term volume profile support, which we saw on a weekly chart, which we know is a huge amount of basing. We've got a big basing area here that we come back to test. The next thing I would like to point out is the Fibonacci retracement from high to low. Okay, comes to the golden zone, as we call it. The 61.8% to 65% zone here is where we base. Okay, is where we bottom. We break it a little bit, come a little lower, but then we springboard out here. The 50 here, as you can see, was operating as support and resistance and support again. Alright, and now we've moved back tested it and moved forward in time. So we've come to a major fib level, we've come to a major support level, we've come to a previous demand level. We've fixed some damage on the chart as well. If we come down to the daily chart here, we can see that this is a dock-off gap that we've got, right? Either side here. I've basically filled the whole area in because there's just no recorded volume here at all. Right, so this was, unlike these areas here, down here, this was an actual genuine big gaping hole in the chart. So very likely we would come back and fill that. We have done. So we've corrected that long-term structural damage to the chart. Now if we bring up a regression trend, we can see that although we have previously broken out of this downward trend, with this move here, you could argue that this is not as strong a move as this. I know it's not the best case or the best argument. What we're talking about when we're dealing with a regression trend is the mean, okay, of all the price data within our range, and then two standard deviations in either direction from that mean. Now, if you know anything about standard deviations, you will know that two standard deviations accounts for roughly 98% of all results within a range. So these are very extreme readings to go beyond two standard deviations. This therefore is an extreme reading as well if this downward trend is still intact, in which case we will come down again. However, I consider that such an extreme move out as two standard deviations from a mean that has got to be an incredibly rare, either an incredibly rare occurrence, or confirmation that the downward trend is over. Now, it's not true confirmation because it won't be true confirmation from a technical point of view until this high here is taken out, because this breaks the sequence of low, lower high, lower low, lower high, lower low, lower high, lower low. That sequence ends when we take out that level, and that's when it's officially over. Now by that point, most people I think would agree that we are well out of this downward trend at that point, and having come off of such a springboard location, I would argue that that is a very strong case for a bottom being in place. Okay, there's no certainties in this gig, but that's looking pretty good. Let's then take away the regression channel and let's have a look at the no, we'll save that for last. Let's have a look at the, where's my other pitchfork? I haven't deleted it, have I? Did I include it in a different count? Bear with me a moment, guys. I seem to have lost something. You know what? I think I deleted it, but either way, it was the pitchfork I was using for this downward trend. I can't remember exactly what pivot I used now, but I think it was a modified shift. It may have been a shift, I'm not sure. It was a nice fit, whatever it was. There we go. So, extreme move beyond the almost to the outer bound here on this move up outside of our regression of two standard deviations we spoke about with the regression channel, except now we can see what was creating support, right? It was the edge of this piece of geometry, this pitchfork here. We also bottom on the 61.8%, the golden ratio of the pitchfork from the median line is where we put in our lowest candle, which comes into the golden zone, into support. Another strong piece of geometry to support it there. We come up to it, and then we backtest it to break out, and this time we go beyond the extreme outer bound of the pitchfork, the 200 level from the mean from a median line. So that strikes me as highly likely that this downward trend is over, and therefore we should be looking for an upward trend of 5 waves to complete and then come back into for a wave 2 of a larger degree before going higher. So there will be a significant buying opportunity coming up if that is correct. It doesn't have to be, but it's likely to be quite a severe reversal when it comes, because it has to convince people that the downward trend is still in play, and it has to trap people in it in order for it to likely be right, because that's just the way the world works. That's the way the market works. So if we're going 1, 2, maybe 3, 4 and 5, and then we don't have to get a deep retracement, but I would suspect one. We get a deep retracement, it looks like it's all over, it looks like we're collapsing, but it will actually be the buying opportunity to come. So let's now take now that we've looked at our pieces of geometry here, let's just have a look at a basic trend line, right? From high to roughly high, not quite there yet. If we do get that 5 wave move that breaks this trend, then it's likely that we'll have an A wave, a B wave and a C wave bringing us back below it. That will be seen by many as a bearish signal, but it's actually wave 1 and wave 2 coming in, and wave 3 is going to be going off. So we'll be trapping shorts here, trapping longs here, and trying to hurt as many people as possible, because that's the way we get these significant rallies and counter trend rallies, and the way we get liquidity to get in and out of trades. So that's the way it works. So that's kind of what I'm expecting to happen. It won't necessarily play by the book perfectly, but either way, there's your case for your classical analysis. Okay. Now, if we look at our indicators as well, and we just come out to the daily time frame, and we just have a look at our lows here, we can see we had extremely strong divergence building up into these lows. A series of higher lows while the market made lower lows. Okay, we can see the same again in the RSI here. Alright. And we're not concerned with the correlation coefficient, that's something I was using for some other piece of analysis. And we can also see, if we look at the daily on balance volume, and we just have a look at this most recent trend, we can see that we've essentially, depending on how you draw it, whether it's there, whether it's there, whether it's there, whether it's there, you know, bar the long-term trend from the previous high, this feels like it's completed and now reversed higher. Okay, so we've still got that same, what we are now starting to accumulate bullish volume going forward on the OBV as well. So we've got the strong divergence of a daily time frame. Now on the weekly time frame, we had divergence on the weekly time frame on the RSI and the MACD into the lows as well, and we actually had weekly we didn't get it on the OBV, but we got an exact low. Now often when you've got a strong accumulation of bearish volume, you will continue to set that lower trend before a reversal occurs. We didn't here, we got it exactly on the weekly time frame with bullish divergence for the MACD and the RSI, both the daily and the weekly. It looks like a strong bottom. The only thing which is turning me off a bit is there doesn't seem to be any significant push from volume, and that's just a little concerning. Now that's not a big worry. The first wave is often not very strong with volume, because it tends to have a deep retracement. The bears are still essentially in control of what is still a downward trend. Those who are not Elliottians would agree, you know, that we are still in a downward trend until we're not, and therefore the bears tend to be stronger, and therefore we don't tend to have a really strong push from volume. It's nice to see. If we'd seen it, I'd feel a little bit more confident, but we would expect to see, once the wave 2 is complete and a break of trend occurs at the beginning of a wave 3 for the 1 and the 2 of the 3 to get the 3 of the 3, at that point we would really expect to see volume ramping up. Okay, so that's what I'll be looking for in the future. So now that we've gone blah 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 14 minutes of classical analysis, and I'm sure you're all bored to tears, let's now have a look at the actual count. And please bear in mind everything I've just said, because you might go, oh right, I'm convinced. Don't let the count unconvince you, because it's not pretty, right? That's why I've laboured the classical analysis as much as I have today. So here we go. Right then. I still see this as the high and this as a swing, we get ABC zigzag, double zigzag into X, and then we get zigzag into Y, into X, zigzag into Y to get the larger Y. I despise it in almost every possible way. It's not breaking any rules, it's just not making any sense. Essentially, we're saying a zigzag here, right? Okay, and we're saying a double zigzag here. Two sharp corrections to make up a larger WXY double zigzag, using a double zigzag within the double zigzag, the Y leg of it, as one of our sharp corrections. What we should see, whether it's WXY or ABC, if we're talking about sharp corrections, we should see the zigzag, the counter trend, and then a zigzag to drive it deeper, or perhaps another zigzag on top of that for a double zigzag or even triple zigzag if it goes deeper. However, there shouldn't really be a swing high that goes to a new price extreme. That should really be reserved for a flat pattern or a sideways correction, and this is neither of those that I can make it make sense. The reason that happens, if we come down to the 8-hour chart for a minute, is because, you know, the peasants over at Wall Street's bet, and I'm not attacking you because I think you're better or I'm better or anyone's better or worse. I'm just saying, you know, if you thought you could manipulate the silver market higher, you were wrong, and more people got hurt as a result of spreading such nonsense than actually gained from it. So in that sense, the bloody peasants who put in this stupid candle here, right, basically broke the chart. If that was a lower high, then that idea of that swing not being there in a double zigzag pattern or a single zigzag pattern makes more sense. We can't have ABC as a result of a zigzag pattern because B can't come back beyond the A. We can only do that in a flat pattern. However, even though it's there, it still forms the first move down of a diagonal, and I can't see any other way of looking at this. So I see this as motive A, B, motive impulse C into W. Flat pattern WXY. It was going to be a flat pattern, I should say. This was going to be 5 ways, but it ended up being 3. So this becomes a sideways combination into X, and then we get a long A of 5 ways, B, and a short C into Y, into Y, into 2 should be underneath that. So yeah, if you're thrown up all over your laptop or your or the table in front of you, I don't blame you. It's absolutely fucking disgusting. It's just awful from an Elliott wave point of view. I hate it. Absolutely hate it, but it is what it is. I'm not going to let it stop me from buying at the golden zone. I'm not going to let it stop me from buying a retracement. I'm not going to let it stop me from buying a broken trend. You know, I'm going to commit either way. I've committed at these lows because it just looked too good. It just looked too good not to. But I just didn't get. I didn't get it to look the way I wanted it to look. Now there might be somebody out there who's far cleverer than me, who's figured it out and made it look look good in an Elliott wave way, and hats off to you if you have. So the next problem, it doesn't get any prettier off of a low, because the first move off of a low wasn't a nice impulse of 5 waves. It wasn't a nice diagonal like this, you know, a rising wedge. It was a 3-wave move. So the last thing you had in your mind was that this was motive, because it was 3 bloody waves and it came lower. Right, so we haven't even got a motive start off of the low at this point. So the only way of being able to wing this is 1 to here, that's motive, 3 to here, 3 to here, and 5 to here for an expanded flat A, B, C into 2, which just comes very, very deep. 2s tend to be deep, but it doesn't fit the profile of a deep correction because it's a sideways flat rather than a sharp. So, but whatever, it's still legal. And then from that point, we go 1, 2, 3, 4, and now we're working on what I think is a slightly extended 5th, where we've gone 1, 2, 3, 4, 1, 2, 3, 4, 5, and we'll come up here into an extended 5th of a 3. Then we'll get that retracement into a 4, then we'll get that push in a 5, and then we'll come back for a larger correction of 1 and 2. Okay, that's basically what I'm expecting. We'll wait and see if it turns out to be right, and that's my count for silver. So I hope you've enjoyed that, but like I said, I've got to give you the count because this is an Elliott wave channel at the end of the day, and that's the best I can do. And it is ugly as sin, but please focus more on the classical analysis, I think, because we've just come back to where we should come back to, and we've done everything we should since. Now, that doesn't mean it's over, doesn't mean we can't break down and go lower. I don't have a count to explain it at the moment, but whatever. Okay, I'm going to look at it bullishly, coming back to where we come back to. and I'm a long-term owner of silver and gold anyway. And if I see 5 waves, if I see 5 waves up out of here, and then I see a big pullback, I'm a buyer. Okay, now we would use the STS standard trade setup that I teach to my patrons. You can find a video for that on the channel of how to get into that trade safely. But either way, that's what I would be thinking. So there you go, there's silver. So let's come over and have a look at gold. Right, gold. Once again, not much happier with the gold count, to be absolutely honest with you. It is what it is. We've done a video on gold independently more recently, a couple of weeks ago, so we won't waste as much time, or waste any time, hopefully going over it like we have done in silver. We'll just drop it on you and then look at the alternatives, I think, would be the fairest way of doing it. So long-term count, right, so this is the primary count as I have it currently. We're still into wave 4, which is now complete. We had a double zigzag into A, we had a zigzag into B, and then we've had 1, 2, 3, 4 waves down in a impulse and a C, and then a 1, 2, 3, 4, 5 ending diagonal in a 5th, which completes with a truncation in the minute 5th of the minor 5 of the C of the 4. Okay, so we get a mild truncation there. This is a bit of one of those points of debate where you'll often see the 5th overthrow the trend line in a contracting leading or ending diagonal. However, in my experience, truncations are more likely to occur as price action weakens in a diagonal that's bearish as we're going towards a low. We tend to get bullish divergence between the highs, and price tends to contract into a low, and if that divergence is going to lead to a truncation, it will more likely lead to it in this circumstance, as opposed to a bullish blow off top, where you tend to see the opposite. You tend to see move up, and then that 5th blows over and then reverses, and we get a break of that 5th wave, and we get a throw over, right? It can happen with an underthrow in a contracting leading ending diagonal to the downside, but I find that you're more likely, I'm not saying it's common, it's not, it's still rare, a truncation, but it's more likely to occur under this circumstance. Now that is not written in any book anywhere, it's just my opinion, so if you disagree, that's fine. I'm not telling you that's the truth, it's just an observation. Moving averages, we fought our way back to the 250 daily moving average with the 60 coming up below it, and now we've back tested it. I would really like to see if this is indeed 1, 2, 1, 2, right? Very small wave 2 pullback at minor degree. I would very much like to see this rocket higher now, because I want to see 3, 4, 3, 4, 5, 1, and then that big correction for the 2 that we'll see in silver as well. Now, if it reverses from here, then maybe it's just a diagonal, right? Maybe we're working on something like this, and then we're going to roll over and come down here. The short-term count, I'm really at a loss over. I just am. So, I'm still bullish off of this low, just like I am in silver, but I just don't have the same confidence, I guess you could say. So yeah, the count's just a bit problematic, but it's legal, at least. Yeah, that's all I'm really concerned with at the moment. If we look at the same bullish divergence that was building up for several weeks on the MACD, as we came down into this low, that's typical behaviour for a ending diagonal. Because instead of getting forceful waves that don't overlap, we're getting contracting waves which do overlap as they come into a weaker and weaker low. Alright, so we tend to see divergence between these levels, and that's what we're getting here. If an incredibly violent correction down, we don't often get that, we just tend to get an extreme reading, whereas here we've got some really considerable divergence building up and a pop. Okay, now if we look at the trend, it's much more obvious, at least since this B wave high that we're calling it back here, that we've broken this trend. Let me just find you I will find you the right pitchfork in a moment, or the right channel. So there's your channel. And it was a really neat channel, there's no doubt about it, right? Stayed and respected it all the way down, and now it's most definitely broken to the upside. I think I may have had a mod shift pitchfork as well, which also shows something very, very similar. There you go, median line check, median line check, median line check, and then bounce out of the pitchfork way beyond the outward bound now. Right then, so that is the primary count. I don't think I've got anything else I really want to talk about regarding that, so let's just go into the alternates and then we'll wrap this thing up. Today was really about getting the silver count across to you. We'll worry about this as and when it fleshes out its detail. If you didn't accumulate at these prior lows, at the moment it would very much feel like chasing it, because there's been no significant retracement at all. There will be at some point some kind of retracement, but yeah, at the moment I'm just not 100% sure about what's going on over here. I'm pretty confident that was the low, but the count off of the bottom, if I see like 5 up into a 1 and a 2 that was very deep like that, I'd be like, yeah, right, that's 1 2, and now we're going 1 2 1 2 into a 3. Whereas the way we've done it with this teeny tiny little retracement suggests that maybe this is actually just a diagonal and we're building into. We'll have to wait and see what time has to say about that one. Alright, so let's turn that off now and come in and have a look at a couple of other ideas. We'll get rid of the long-term count. So what have we got here? DZZ alternate. So if we want an explanation, an alternate explanation as to how we're gonna, oh, is that the next? Bear with me. Yes, we need both of those. Or do we need? I'll figure it out in a minute, guys. Just patience. We've got so many different ideas. Right, so here we yes, I know which one that goes with. So DZZ alternate count is we're using a whole bunch of double zigzags to explain 7 swings instead of 5. Okay, so we've got WXY, WX, WXY, Y, 2 double zigzags, right, to get this 7 way, this appearance of 7 swings instead of 5 swings. So 1 2 3 4 5 6 7. Well, sorry, 8 and 9. We're including this as a truncation, so 9 swings. So looking at it as potential double zigzag. So that's a different way of looking at it. What that means is that instead of looking at this as A, B, C, so 3 3 5 flat pattern, we're looking at it as 3 3 3 instead. So double zigzag, zigzag, double zigzag, 3 3 3. It's basically the same thing, it's just a different way of getting there. I changed the B wave triangle here somewhat, but other than that, it's basically the same. Alternatively, we have our idea that we've got a cycle top up here of cycle wave 1, and this is 1 2 3 4 5, and it's not 7 swings, it's 5 swings with a flat in between it. So A, B, C into B. This was A, this is B, and now we're going to get 5 waves down in a C, bringing us well down below probably 1300 perhaps, or into that region. And this is going to be a very aggressive zigzag which comes down. So what don't I like about this? So if I can just bring it back up, when did I just put it? So what don't I like about this? 1 2, I've got a sideways structure here. 3 4, I've got a sharp structure here. So alternation, I can live with that. However, if we want to make sense of this structure, I have to extend it out as a sideways correction as well into a WXY sideways combo, and it's double zigzag into X into an X wave into a triangle. Triangle has to be the terminal or pre-terminal phase. So we then come up in a very sharp 5th wave to the top. So when we look at the whole structure, it looks like this, and I find that a little dodgy looking as an impulse. That 1 2 3 4 looks okay, that 5th looks really weird. Okay, it doesn't make a new high, it's very sudden. 5th waves tend to be quite strong in commodities markets, not pathetically weak like that. So I find that a bit perplexing, so that's the main problem I have with that. However, with the primary count, the issue I have with the primary count that we're working on is how the 1 and the 2 and the 3 and the 4, alright, it looks okay as an impulse, but this 4's gotten awfully deep and awfully long, a little too long. It's not too long to say it's legal. If we take the wave 1 to the 3 to project from the 2 to get an Elliott wave channel, we can see that we don't channel nicely to the low here of the 4. So we would use the second method, or the final channeling method provided by Elliott wave theory, and shift it from the 2 to the 4, okay, and then project from the 3rd to get the 5th. And then it kind of looks okay. It's still not beautiful, but it kind of looks okay. So it's generally, because of the length this correction has taken, generally a bit perplexing and a little confusing. The final uber bearish idea, and the one I like the least, is the idea that we've gone A down into 2016 from 2011, B into this peak here in 2020, and now we're working on 5 waves down. Sorry, I put that in the wrong place. Of 1, 2, 3, 4, and 5, down to roughly below a grand. Okay, now why don't I like this? For love nor money, I can't make that look like a motive wave. Okay, I've tried to make it work as an expanding diagonal, but I honestly don't believe the zigzag structure is there in the early part of it. I think it definitely works better as two zigzags with the intervening flat. That's just my opinion. I'm not going to say you can't have it. Plus, the wave 2 comes back to 99.98%. Strikes me as incredibly deep. Now, wave 2s are deep, but when it's basically wick over wick and there's no body of the candle, I find that a highly questionable wave 2. We still have 7 swings to deal with rather than 5, but at least we can go 1, 2, 3, 4, 5, A, B, C flat, 2, 1, 2, 3, 4, 5 within the 3, 4 and 5. So we can come down here deeper like that. Now, if that's your count and you are convinced by it, that's fine. I'm not saying it's not possible, I never would. I just don't think that's a very convincing motive wave, and I don't think a 99.something% retracement in a 2 is particularly convincing. The other thing is, when I look at silver and I look at that bounce off of that volume and that 61.8% retracement and that impulse up and that correction back from an actual lower low, having not made new highs, the idea that silver will go to the moon while gold collapses just doesn't make sense to me at all. So I have serious problems squaring the circle on that one. So I'm going to... now you might say, oh, Tommy should focus purely on the technical and not on the fundamentals. I think fair enough, as a technical analysis, that's a fair point. However, there comes a point where your suspension of disbelief has to at least have some cognitive grounding, at least in your own mind. And I can tell myself that something's happening because it's technical, but if I don't believe it at all, because of my own doubts in the Elliott wave behaviour, my own doubts in the way it's presented, then surely as a tiebreaker I should go with the more logical choice. As a tiebreaker between two ideas, if I can't make a technical decision based on probability, then surely having some fundamental bias to help make a decision is the only option you have left. And that's where the situation I found myself in with gold here. So anyway, I have been waffling way too much this episode. My voice has gotten even sorer, but thank you very much for putting up with me. I think we've bottomed in gold and silver. I'm going to say it. I think we're going higher. I think we are going to get a very significant retracement, which is going to convince everyone that it's actually wrong and it's bearish. And I think that's ahead of us. Might not be here yet. Might be a little way to go. But that will be a significant buying opportunity into the future. And if the silver count on the long term does turn out to be correct, it will be a truly stupendous buying opportunity. Okay, because before we can even talk about the completion of a larger wave off of this pivot here, we've got to accept that the clearing of the high is absolutely inevitable under those circumstances, and could be done looking at the scale in the wave 3 alone, 4 and 5. Okay, now at that point we have to ask ourselves, is this 1, 2, 1, 2 of a much larger 3? If that's the case, you want to be in silver for the next 2 decades at least. Okay, now this is all speculation, I know, but that's a lower low. We broke the high in gold, we're nowhere near it in silver. We came off a higher low in gold after saying that was 1 and that was 2. That's not an option here in silver. That's a flat out, all out, proper low. bona fide low. That looks impulsive as hell. That looks corrective as hell. I'm happy to say 1 and 2. That's based, and off we go. Alright, if I'm wrong, but that's it. Alright then, that really is the end of it now, guys. So thank you very much for joining me on this technical analysis of gold and silver. If you're new to the channel and you like what you see, please subscribe, smash the like, hit the little bell notification icon to remain informed of future video releases. Feel free to leave us a comment in the comment section below. As always, an enormous thank you to my Patreon subscribers. Your support is greatly appreciated. If you're interested in joining the Patreon, please follow the link in the description box below. Head over, have a read of the tiers, and feel free to sign up. Alright guys, take care of yourselves. I'll be back with you as soon as possible. And if I don't see you again this week, have a very Merry Christmas. And I will hopefully see you before the new year. All the best. Bye bye.